Week and World Investor Week is a global campaign to raise awareness of the importance of investor education and protection. This entire week, we talk on various investment related aspects, right from investment instruments, investor protection, education, and awareness. Let's kick off this week with a very special guest. I have Monika Halan, author and analyst, who will talk today on various myths which are related to investment, the investment process, or the kind of understanding investors have of investment instruments. Monika ma'am, good evening and welcome to the Money Show. And we've discussed this a lot of times via different kind of topic of discussions, but then let's debust the kind of myths generally investors have when it comes to investing in equity markets, or maybe generally the concept or the notion of investment that people have in their mind, because a lot of time Indians are not able to decide whether saving is different from investment. A lot of times it's like a clubbed concept for them. So what is the first myth that you would want to highlight?
Kavita, thank you so much. It's indeed an honor to be and talking about things which matter to investors. One of the biggest things that I have noticed is that people get fixated on return of an investment, which of course is a very important thing, but they forget to think of things like risk, liquidity, availability of money when you need it. So when you think of an investment, it's not just the return that you're looking at. Don't get fixated only on the return. There are other attributes of an investment which are equally important. For example, if your investment is for a shorter term horizon, then more than risk, more than return, you have to be focused on the risk. You need that availability of money. It is in a longer tenure investment that you can take more risk and have a focus on a higher return. So one of the first things that I want to start my conversation with is to say, yes, return is important, but that's not the only thing which is important, Kavita.
All right, let's focus on myths related to specific investment instruments. And over here, let's begin with mutual funds. A lot of time investors think that mutual funds means directly investing only in the share market. What's the kind of myth which is there that investors need to just go away from?
I agree with you. Absolutely. Mutual fund is not a product. People confuse the mutual fund to be a product, a destination. It is actually a pipeline which is connecting your money to pools of money which are invested in stocks, bonds, gold, real estate, and combinations of that. So you invest into real estate through REITs, which is at the moment not so developed, but investing in shares, in bonds, and gold, and combinations of these is the destination for a mutual fund. So when people say that I'm investing in a fund, they tend to think only equity. But you're absolutely right. It's also debt products, and people who understand debt funds are able to use them very efficiently for both their near-term and short-term needs, much better than what they would a savings deposit and a fixed deposit. So yes, it's one of those major myths that I've done SIP in a mutual fund. Now, again, SIP is a route. It's like a recurring deposit without the guarantee. It's a recurring deposit in a mutual fund. So it's a road into a destination, which then takes your money forward into the place that you choose it to go. So the iterations are many. And you're right, it's not just equity.
Right. One more very important aspect when it comes to the investing in equity. I would like you to explain our viewers the concept of having inflation beating returns and how equity can be helpful, okay? But a lot of times investors also think that maybe if they are invested in equity for a short period of time, then too they can get a hedge over inflation with this particular asset class. Is that true? And if yes, then what kind of a duration that you should be playing along in order to get inflation beating returns from equity?
You're right. Inflation beating returns are possible from equity, but what you need is a large dollop of patience. You need to have a horizon of 7 to 10 years at least. All right. It does take 7 years for a business cycle, for a economic cycle to get over, especially when markets have been up. And this is what we have seen in the last few years. A new generation of investors comes in, and they are unable to understand that markets go up and down. So they begin to think that 3 years double my money. That doesn't really happen, because there can be long periods of time in which the stock market gives returns which are worse than a fixed deposit. It has happened just before the 2020 rise in markets, just short of that. If you did a 5-year back testing, a lot of people found that their fixed deposits actually had performed better. But then it took a little bit, it just took a few months for that entire flat return to get recovered, and the market did give good returns. So, yes, investors must understand that you have to have a long term perspective when you come to the equity market. And one of the best ways to get that average market return is through an index fund. We can predict, looking at two numbers, the equity, the GDP numbers and the inflation numbers. You can make predictions as to what the average return would be over a 7 to 10 year period. So typically what we say, it's GDP plus inflation plus something called an equity premium, which at 6% GDP, 6% inflation, you're already reaching the 12% number without even building in the equity premium. So, but to harvest that return, you need patience. Equity is a slow cook. It is not instant noodles. You will burn your fingers if you come into the market expecting guaranteed high returns in the short term, Kavita.
Right. One more concept, which investors are really banking on these days is investing in only mid cap and small cap just to beat inflation or maybe have high returns in short term. Okay, this is the biggest myth that is the most active right now, Monika ma'am.
Right. No, you're right. And we've seen this whole thing so many times. We've seen the cycle. Investors seem to have an all or nothing approach. And they look at last year's return. They're looking at returns which have already been booked. And then they come into a slice of the market. So instead of an all or nothing, so their questions will be, I'm going to move all my money into a mid cap, or I'm going to move all my money into a small cap. The approach should be, it's a pizza pie approach, or it's an Indian thali approach, where you have portions divided across less risky equity assets and higher risk assets. So typically, if you have half of your equity portfolio in a large cap fund or an index fund, and you do a quarter pie slice each for mid and small cap, you're building in both stability and growth into your portfolio. So investors need to understand that, you've seen the small and the mid caps give great returns, but I can point to so many data points in the past where both of these have horribly underperformed the market, the broad market, or they have given returns which are lower than the Sensex and the Nifty. They have gone into losses. So, timing the small cap and the mid cap will really burn your fingers, lose you money. Please think of a portfolio approach, have half your money in a safer equity asset, and then build your slices of the pizza pie with small and mid cap. So, no, I don't agree that you should rush into these risk assets just because last year or the last 3 years were great years for these places in the market.
Monika ma'am, let's talk about the entire debate of active versus passive, okay? So is it right to say that active always gives you more return than passive, and to earn more returns in a longer period of time, you must just bank on active and just totally ignore passive? What is the kind of myth that goes around between these two way of investments?
So that active versus passive debate is largely related to people wanting to target a higher return than the market index. And what we have seen is that the large cap part of the market has found it difficult to beat the index Sensex Nifty 50. So then the attention changes towards parts of the market which have outperformed these indices dramatically. They have outperformed in the last few years. Again, my suggestion is have a mix of the two. You don't always have to choose either or. In my world, it is an and. So you want to have, passive part of your market can come through an index fund, and the active, where we are seeing still large alpha possibilities in the mid and small cap, that you can choose through an active route. So your portfolio is a blend of both active and passive, where the low risk part is in a passive fund, low expense ratio, low tracking error, and your higher risk, even within equity, is sitting in active funds, which you have chosen through due diligence. You have not picked last year's winner, but you've looked for consistency of performance over 10 years at least. You've looked for the risk metrics, you've looked at expense ratios. Then you have chosen. You've not chosen because somebody has given you a tip. Should you do all these things, you have a robust portfolio, and you don't have this active or passive debate in your mind. You're saying it's active and passive, Kavita.
Mhm. One last question, ma'am, and then we will wind up the discussion. In fact, there's a lot of themes and topics on this, but then I'm really running short on time. But one last question: are mutual funds risk free? Is this a
No,
myth?
no, of course they're not risk free. Look, again, what is risk free? Is a savings deposit risk free from inflation? It is not. Is a public provident free risk free from the lack of liquidity? No, it is not. So, how are we defining risk? We are defining risk very narrowly in terms of only volatility, which is a short term dramatic up and down movements of the market in terms of the price. Of course, stocks are more susceptible to this volatility than the bond market. Therefore, there is going to be the risk of volatility attached to the stock part of it. But mutual funds, being market linked, the price is marked to market every business day, makes it susceptible to the prices moving up and down. You don't check the price of your real estate. You don't know what's happening on a day-to-day basis. Things like a fixed deposit in a public provident fund, those are guaranteed return. They are risk free in terms of what you get back. But a mutual fund will carry the risk of volatility. There are other kinds of risk, of liquidity, of uh, being sure that the money is there when you want it. So you have to evaluate all of these risks before you get into a financial product. And absolutely no, mutual funds are not risk free. They carry different kinds of risk. You need to see the face of different faces of risk and then decide which one you can handle.
All right, with that, thank you so much, Monika ma'am, for being on the show today and helping our viewers with this and beginning our World Investor Week with this very important discussion. Thank you so much. All right, before we go into a break, let's listen into a fireside chat with